Good afternoon. Well, this has been a long and very valuable day for all of us, and a lot of the views that we heard all day have been really quite macro, very much from the top down. In this session, we're going to step a half step away from that and take a look at European quantitative easing and the state of European Union banks. Now, in this session, your distinguished panel, which is Gilles Noblet and Chris Whalen, we'll take a look at a few things that give you a very different kind of perspective, we hope, and that you'll walk away with, hopefully, with some new ideas. We will try to put QE in the ECB into some context for you, discuss some of the downsides, perhaps, of both US and EU quantitative easing. We'll take a look at the framework for regulations, regulatory requirements in general, and capital requirements, examine some transmission mechanisms for quantitative easing, and share some tentative impacts of quantitative easings on the banks. So let's start with Chris. It's all yours.
Well, good afternoon. I want to thank the Banque de France and the GIC for inviting me to speak to you today. The comments I'm going to make are based on a research note that's available on the Kroll Bond Ratings website. I'm head of research at Kroll. I also am responsible for ratings for financial institutions, corporates, and sovereigns, which is about half of our business. Firm's about 5 years old, 150 people. We're the smallest competitor of Moody's and S&P, and I like to think that we do the best work. I'm going to, I think, touch on a lot of the comments that have been made all day, but from a different perspective. I don't think of myself as an economist. I think of myself as a historian that understands economics. I worked at the Fed of New York in the dark ages. In fact, I was very amused by some of the old machines they have down in the lobby. I think I recognize some of them. When I used to track the investments of Citigroup offshore, we used index cards that were actually pinned to the wall of this room that we would keep locked. But I think the important thing when we're talking about monetary policy and the response to the crisis is that in a large sense, nothing has really changed. In fact, if you look at the United States, interest rates have been low since 2001. They were raised in the period just before the onset of the crisis, but effectively we've had low rates as a means of stimulating nominal growth in the United States going back many years. If you go back to the 80s and just trace a line for Fed funds through to today, interest rate policy, monetary policy have been one of the chief means of trying to keep growth moving. Now, when you think of it in those senses, the addition of asset purchases through quantitative easing, both by the US and the Europeans now, is simply a means of trying to add to that. In other words, to stimulate asset prices so that you change investor preferences and you convince them to invest. We heard about investment today and the focus of many European governments on trying to stimulate investment in a variety of different ways. The downside, of course, is that none of the responses to the crisis really addressed the core issue, which was not a lack of capital, but rather hidden off-balance sheet liabilities that, when revealed, scared investors, and we had a run out of the market. The central banks had to come in and provide their funds, their capital, to replace the private capital that ran off the stage when people realized that the global balance sheet was out of balance. And the implication was that equity would be wiped out, so they took their equity off the table and they ran away. The fact is, even today, there are tens of trillions of dollars worth of debt that were created prior to the crisis, largely in non-bank, off-balance sheet vehicles that still have not been resolved. Whether you're talking about vehicles spawned by US banks, home equity loans that are still underwater, sitting in securitizations, or loans to Greece, I think the core conclusion that we all are confronted with, at least implicitly, is that policymakers do not want to deal with debt. They've decided that it's better to steal money from savers slowly through low and negative interest rates than it is to restructure debts which are manifestly uncollectible. You know, I think too that when you think about the effect of low interest rates in the context of investment, in the context of consumer demand in aggregate, you have to understand that in the US today, between the depressed payments to savers and the overall low interest rates earned on fixed income securities, for example, we're taking something on the order of $1 trillion or more a year out of the hands of savers and transferring those resources to debtors. I'll give you a striking number. Before the crisis, the cost of funds for the entire US banking system was about $120 billion a quarter. At the end of 2014, that number was $14 billion. That was the total interest expense for the entire US banking system. And so the Fed has had to push down the cost of funds very aggressively to essentially maintain the net interest margin of banks. But that money is coming out of the pocket of grandma and grandpa. And contrary to what some of our friends at the Fed believe, it is not just families of childbearing age who spend money. Grandma spends money too, and if she is not able to make ends meet with her savings, and these are people, remember, who did the right thing. We're actually punishing the righteous so that we don't have to deal with the question of debt in a very large sense. I think the same comparison can be made here in Europe. I mean, again, savers are slowly being robbed of their wealth because policymakers don't have the resources or the will or both to deal head on with bad debt. Look at the situation in Greece. The bailout for Greece was really a bailout for German banks. And whatever you want to say about those banks, they made the loans to Greece. They sold the Greeks a lot of goods and services, and then they turned to the Greeks and want to be repaid. I think that in opposition to the stated intention of quantitative easing and low interest rates, in fact, the effect of these policies is extremely negative. I think one of the reasons that it's almost certain that we're not going to hit the inflation targets of the Fed and the other central banks is a simple reason that people don't have enough money to spend, whether it's cash or credit. There simply is not enough demand potential out there to enable us to get anywhere near a 2% target. It's just not going to happen. The other thing that's fascinating is that, you know, throughout the crisis and after, we've had a procession of regulators talking about how we have to have higher capital and various other new regulations to prevent a recurrence of the disaster. And yet again, you know, it was a combination of off-balance sheet finance and securities fraud that really caused the problem. We had a 50% failure rate among large banks in the United States. Everybody talks about little banks failing, but the reality is, you know, we had a horrific annihilation of large banks, not because they ever consumed capital, but simply because they became illiquid. I recall sitting at the Chicago Fed last year while a friend of mine at the Board of Governors talked about what happened to Wachovia prior to their arranged marriage with Wells Fargo. You literally had bondholders showing up demanding early redemption of debt. The bank became illiquid because a portion of their balance sheet was funded off the markets. So, you know, I think that when we sit here and talk about, you know, recovery from the crisis and how we're going to get there, one of the things we have to realize is that because of the mix of policies that we have, low interest rates, higher capital for financial institutions, restrictions on lending. In the US, for example, the bottom third of potential homeowners can't get a mortgage now. Congress decided that people who have a FICO score below 700 really shouldn't get a loan because someone is taking advantage of them. And so as a result, whereas a decade ago we did $4 trillion worth of 1 to 4 family loans in the US, this year we did $1 trillion. Now 4 was too much, clearly. A lot of those loans were bad, but 1 is too little. 1 implies that we're going to run off the amount of financing available to the real estate sector by about 3 to 4% a year, which to me is not good. In fact, if you think of it over the past decade, interest rates have been falling steadily, and volumes in the mortgage market in the United States have been falling as well. You don't have the same dynamic here in Europe because home ownership isn't as emphasized in many European countries as it is in the US. But just as an economic indicator, I think you have to look at the fact that one hand is trying to stimulate the economy through low rates, all the while taking income out of the system from savers and giving it to debtors. And then at the same time, as a matter of regulation, we're saying we need less leverage. You know, anybody who knows anything about economics knows that you need credit creation to create jobs, encourage investment, and to make economies go. And, you know, to steal the great metaphor from Adam Smith, you don't want the wheel to slow down. And the thing that I worry about the most is that, in fact, the great wheel of circulation is slowing down, simply because we've decided to do a lot of things in terms of policy responses to the crisis, which are in conflict. You know, we used to have people at the Treasury and the White House who would actually take a step back and think about these things in a big picture sense, but we don't seem to do that anymore. And I think that's badly needed, both here in Europe and in the US, for the simple reason that if we don't, then I think we are doomed, as some of the other speakers have suggested, to a low or no growth future. You know, think for a minute in terms of many of the people in this room who make investment decisions for a living. If you don't validate asset prices by raising income and GDP, when you stop doing what you're doing, then the asset prices are going to fall again. You know, this is basic economics. Or as I like to say, you know, most modern jet airliners need to go about 160 knots before you pull back on the stick and you take off. How can the Fed raise interest rates if we don't have sufficient demand for credit to validate that decision? You don't want them to raise interest rates until you have demand for credit. But on the other hand, remember grandma. Grandma needs to have money coming from her savings to live and spend and get the economy moving again. So I think, unfortunately, our policymakers have painted themselves into a corner. You know, we need, I think, to take a lesson from the 1930s. In a funny way, they were ahead of the game because they went through deflation quickly and then they had to deal with it. And then they had a war, which is essentially how we got out of the Great Depression. But I think that if we don't realize that dealing with uncollectible debt, whether it's in Greece or Spain or in the United States, is a necessary condition for getting the economies to grow again, then ultimately I think we're all missing the point. This takes courage. I often think of people like Jesse Jones and Leo Crowley, two of the giants in the Depression era. Jesse Jones ran the Reconstruction Finance Corporation. Leo Crowley was the second chairman of the FDIC. Those two men restructured the U.S. economy by themselves. And by the way, the Fed was not involved. The Fed opted out of this entire process. And the merchant bank that was the RFC was funded in the bond market. They really did what was necessary to make the economy run again by resolving debt, by recapitalizing companies, and by getting things moving again. So with that, I'm going to let my colleague take over, and I look forward to your questions.
Thank you very much, Chris. Thank you, Steve. First of all, thank you for the organizer of this conference. I think we heard a lot since this morning, very stimulating debate. Thank you to the Banque de France and Governor Noyer. It's always a very emotional journey for me to come back here after having served this institution for 15 years. When I left this institution, the auditorium was not existing. Not that I left late, so long ago, but it was not existing. The topic I've been asked to address is QE and the state of banks. And to be honest, this is a difficult topic. There are many channels. I don't have the answer yet on the impact of QE on the EU banks. I think it's too early to draw a conclusion. Nevertheless, what I want to try to do in the thread of my intervention is to show the central role of the banking system in Europe in the transmission mechanism of monetary policy during the crisis, including in the form of QE, which is paradoxical. QE is about purchasing securities, but the banks are big holders of securities in Europe, and so they still play a role also in the QE that we have embarked upon. Just to recall, many of you know this figure, 70% of the financing of the private sector in Europe comes from the bank and 30% from the market. In the US, this is the reverse, 70% from the markets, 30% from the bank. So this explains and will explain maybe the different channels of transmission of the non-standard measures taken by the Fed and by the ECB. I will try to focus on 4 points today. First, how the banking sector was at the center of our actions during the crisis. Second, what are the key transition channels that we can expect from our QE, our extended asset purchase program? Third, what is the impact of this QE on the profitability, liquidity, solvency of the banks? And here again, I will be very cautious. We don't know exactly what will happen yet, at least the extent of this impact. And finally, the international effects of QE on both sides of the Atlantic. If I start with the actions of the ECB during the crisis and the central role of the banks, I think we made the distinction very clear from the start between the monetary policy stance, the rate that the ECB decides upon, the official rates, and the provision of liquidity. And we took a lot of measures to provide liquidity regardless of the level of the interest rates. And as a matter of fact, the EONIA rate, which is the interbank rate at the short-term maturity, most of the time fluctuated at the low bound of our corridor, which was adding to the accommodation of our monetary policy. And we did that with several measures. As you know, we provided full allotment at fixed rate. We widened the eligible collateral, which was already wide, but we widened it further. And we also provided liquidity in FX with swaps. And at the same time, you know, we also introduced forward guidance in a context of very low interest rate. Despite these actions, we had two problems concerning actually the banking credit channel. The first problem was the weak transmission from the market interest rates to bank credit rates in absolute level. And the second problem was the large disparities in this transmission across countries, stressed versus non-stressed, and across sector, SMEs again against big corporate. Initially, we provided three responses to these problems. First was the OMT announcement aimed at dealing with two issues, the redenomination risk, so the unfounded fears that the euro area would break up, and second, to restore the transmission mechanism in all euro area countries, and so especially in stressed countries. The second answer was asset purchases, first with ABS and commercial covered bond paper. Why these two markets? Because again, these two markets have a close connection with bank financing conditions. And the third answer was the TLTRO, which is a form of targeted lending, a bit like the funding for lending schemes in the UK. So again, you see the central role of the banking system in our action. So these actions produced an impact, a positive impact, but yet the situation was not fully satisfactory. Again, with two problems. The transmission mechanism was restored, but not fully. And second, we had a situation of low actual and expected inflation. So this is where our QE EAPP come into action, with two objectives: push up inflation and inflation expectations, and second, revive the credit further. So what transmission channel do we expect from our QE? So first, the textbook is clear. First, we expect a direct impact on the yields of the asset that we purchase. Second, we expect an impact on other riskier assets through the rebalancing channel. And third, we expect a confidence and signaling impact all along the term structure of interest rate and on inflation expectation. The impact so far has been good. I leave apart already the fall in yields that happened since last November. But let's say after the announcement on the 22nd of January, we had approximately between 15 and 30 basis point decline in yields according to different countries after the announcement. And again, although it's difficult to disentangle the QE impact from other impact, but probably again 10 to 20 basis points since we started purchases on the 9th of March. The average duration of the bond purchase is about 8 years, which proves that we act at the long end, medium to long end of the curve, which is of course good for investment. There has been 4 concerns raised by observer or market participant. First, will we face a scarcity of bonds due to lower issuances this year? This has to be assessed against the huge stock of bonds that is in the market, and according to our expert in the various central banks, we do not witness liquidity problem at the availability problem at this stage in buying bonds. The second issue could be the reluctance of some sellers to sell their bonds. At the same time, selling their bonds could improve their liquidity ratio, could reduce their sovereign exposure, and through profit from these sales could improve their capital ratio. The third issue is the reduced liquidity on the bond market because of our purchases. So we will have to think of what we can do, maybe by developing some securities lending framework. I think we are reflecting on this kind of issue. The four concerns that has been expressed is the lack of attractive investment alternative from some investors, especially insurance companies, for example. But because, again, banks and asset managers are big holders of bonds in Europe, we do expect that these institutions, which probably have a flexible mandate, can invest in alternative securities. I turn now to the third point, the impact of our QE on banks, on European banks. Again, I want to be very cautious and tell you it's very early and complex to assess and to give any assessment with accuracy, because there are many factors at play, of course. What is the impact on yields depending on the various bonds purchased in different countries? Second, the bonds that the banks will sell to the ECB, how these bonds are accounted in the books of the bank. Are they at market value? Are they in available for sale portfolio? Are they hold to maturity? So of course, depending on this accounting, then you have an impact on the profit you can make on these sales to the ECB. In a background, of course, also of CRD4 and the progressive kicking of the new provision regarding capital regulation. What can we expect anyway on the banks? First, a reduced funding costs for banks, because the decline in yields on government bonds should translate also in the yields of banks bonds, sorry. On the other hand, we could expect probably a slight fall in the net interest margins of banks due to the flattening of the yield curves. However, this slight decline in the net margin could be more than offset by the profits that the bank could draw from the sales they would make. Again, the extent of which depend on the accounting treatment of these bonds in their books, and also higher profit would, all in all, everything being equal, reinforce slightly the capital ratios of the bank. Finally, we can expect an increase in the bank lending activities or an increase in the purchase by banks of private securities. To what extent banks will restore lending or purchase private securities, we will have to see. I think it's too early to say. If I turn now to the last point of my intervention, the international impact of QE, the first point to mention is that QE can have two opposite effects on international variables, or any non-standard measures, actually. If non-standard measures are perceived are reinforcing the domestic economy, restoring the domestic economy, alleviating the crisis, they should have a positive impact on the exchange rate of this country. If remuneration consideration are the main element, of course, non-standard measures should lead to a depreciation of the currency because there are capital outflows in other regions of the world. In this respect, the first non-standard measures of the ECB 3 years ago actually had a positive impact on the euro exchange rate because they were perceived as alleviating the crisis in Europe and showing the determination of European authorities to solve the crisis. So the euro appreciated. So in international fora, we were not faced by criticism from the EME saying, through your non-standard measures, you are dampening your exchange rate at our expense. So different from the Fed or from the Treasury, the US Treasury, at first stage, we were not faced with this because the euro did appreciate. Before assessing the international impact of the recent QE of the ECB on the exchange rate, let me come back to what happened in the US in this respect. We had, let's say, 3 different phases of QE. QE1, which is the LSAP in 08 and 09, triggered actually capital inflows into the US and an appreciation of the dollar because there was a confidence effect. There was still the crisis in the US, so these measures were seen as restoring the soundness of the US economy. So the bond yields in the US declined by about 100 basis points, and stock prices increased by probably something like 20%, if I remember well. QE2, which was made mainly purchases of treasuries, and QE3, purchases of MBS, had actually little impact on US yields, but had a dampening impact on exchange rate of the dollar, which depreciated probably by 2% in effective terms, which triggered by large capital outflows, especially into the EMEs, which triggered the whole debate we had in international fora on the impact and the spillovers of US monetary policy on EMEs. And this is the rebalancing channel. What about the EAPP? So again, two yardstick, I would say. The announcement by the ECB of its purchase program on 22nd of January triggered overall 2% depreciation of the euro in effective terms. And we tried to identify the impact on global equity prices, maybe in the order of 1%, but I think this figure is marginal. But the impact on the exchange rate was, of course, clear. And since we started the purchases of bonds, again, it's difficult to assess, but the euro probably, because of these purchases, depreciated between 1 and 2% further. As a conclusion, I wanted to show you how the banking sector was at the heart of the monetary policy of the ECB. This could change in the future if we would change the financing structure of a European corporate and households. And after all, this is the agenda of the Capital Market Union that we try to develop in Europe in order to change the sources of financing of companies, especially from banks to markets. Thank you.
Thank you, Gilles. A quick question for Chris. I hope this is quick. You said that central bankers have boxed themselves into a corner, and you said it's in part because they don't want to deal with debt. So what would it look like if they were to try to get out of that corner?
Well, going back to the point my colleague was just making about the impact on financial institutions of low rates, I think you got to remember in the US and Europe both, insurance companies, pensions, and banks have been living with low rates for many years. And in the early part of that period, you were giving the holders of current debt a gain. If they decided to sell the paper, they could take a capital gain, but then they would have to reinvest in a much lower yielding asset. So yes, you can enhance profits short term, but you're lowering the earning assets of the bank or the insurer overall. So today in the US, the system is converging on a net interest margin of 2%. And I think this is one of the things that ultimately is going to have to drive the Fed to allow rates to go up slowly, is that they're going to be faced with insurers and financial institutions who depend on leverage, who have targets of 6 and 7% to meet their fiduciary requirements, and they're making 2%. So at some point, something has to give. I mean, I deal with insurance companies all day, and they are investing in anything and everything you can think of. So to the extent the Fed wanted to change investor preferences, they've achieved that objective. But I think over time, the tension is going to be, on the one hand, Steve, to allow cash flow to start flowing back to savers, while at the same time realizing you don't have enough demand for credit to validate higher rates. That's, I think, the real rub that faces all central banks, which is you push asset prices up, and in the case of the US stocks, bonds, both, right? But if you were to normalize interest rates tomorrow, both asset classes would go down. And I don't think the markets are really prepared for this. Even the hint of a change in Fed policy has caused a lot of private equity and corporate bond investors to run for the door, and they're all coming to me saying, hey, would you rate such and such private equity company we own? We'd like to sell bonds and thereby pull their equity out. They're already running for the door. And the reason they can't sell these things is because they don't make sense. I won't use any names, but there's an awful lot of new entities out there that are floated in the equity markets and the debt markets that, frankly, from a ratings perspective, don't make sense. And the only reason they got financed was because rates were so low.
And Gilles, there have been a lot of international agreements, whether it's Basel II and III and others, capital accords and leverage accords and others. And I'm wondering what you think about the impact of some of the regulatory changes that have been made and some of the structural changes in the European banking system as we move perhaps toward more of a banking union.
Well, First, I think from an institutional point of view, the ECB fully support the agenda developed in Basel and replicated actually in Europe through our own regulation system. So I think in that respect, all the reforms aimed at strengthening the capital, developing a loss absorbency capacity, the liquidity ratio, I think these are very important elements. We understand that this can create constraint from the participants, so they have expressed a lot of doubt. So we are ready sometime to calibrate part of this regulation, but I think the agenda is clear. We fully support this agenda, also in Europe. And as you know, in Europe, we have done a lot in that respect, also on our side. So we have now a single supervisor. We have a resolution framework at the European level, which was also not existing. We have a BRRD, so we have a framework for bail-in liabilities. So I think we have learned from the crisis, and we try to build a more solid system, which basically would prevent all these difficulties. But regarding the regulatory agenda, we fully support this agenda. We have, of course, we always have some amendments that we can propose, but basically we are strong supporter of this agenda.
One interesting thing about what he was just saying about the regulatory agenda is that it is reinforcing the role of government debt as the primary holding of financial institutions. If you go back to 1998 when we had long-term capital management and Kidder Peabody, the SEC in the United States changed an obscure rule that I won't go into that basically made it impossible for non-banks to issue commercial paper. They handed the banks a monopoly. And today, they're getting ready to change the rules more so that banks can't even issue their own paper, especially small banks, into money market funds. So we're going to turn the entire system into a government monopoly. This doesn't encourage growth because non-banks are the reason that the 1990s are looked back on with such affection. It wasn't Bill Clinton and Bob Rubin. It was the fact that non-bank companies were creating credit and creating jobs. And instead, because of the crisis, all of the regulators, all of the policymakers have decided that we're going to fill banks with government exposures instead of private sector exposures. So the banks instead push the private sector exposures off balance sheet and fill their balance sheets with treasury bonds and government bonds here in the EU. That's not the way you get an economy to grow. And you could, in fact, see those exposures turn around and bite banks in the future because remember, if you're in the OECD, you're basically considered high investment grade regardless of your fiscal situation. I run our sovereign book at Kroll. It's quite amusing sometimes when we have these discussions. But the reality is all regulators view all government debt as much better than private sector debt, and I think that's a problem. There's a way to manage private sector risk without closing the door on that sort of financing.
Thank you, Chris. A couple of your questions? Sir?
Paul O'Brien, ADIA. We've talked a lot about QE, actually all day, but not necessarily the negative deposit rate as it affects banks. Why stuff in all the excess reserves into the banking system and then tax them?
I think it's a very difficult question. Maybe I let Mr. Noyer reply to this question.
Well, look, I don't think it's a difficult question, and I pay homage to David Kotok. I think that one of the first things that the central bankers should be doing is raising the rate they pay banks for reserves. We have $1.5 trillion, 10% of the U.S. banking system sitting at the Fed. I'd like to see them raise the rate they pay the banks so that they can leave the profits in the banking system instead of giving it to the U.S. Treasury. They should neutralize the spread on their portfolio so that it's not regressive. Because, you know, think about it, just about everything we're doing in QE, both in Europe and the U.S., is advantaging public sector entities, large debtors, and hedge funds. And that's great, but you know, at some point we have to rebalance the equation back in favor of investors and savers.
Okay.
Quick question for both of you. There's 1.3 or so trillion excess reserves at the Fed that are deposited there by U.S. subsidiaries of foreign banks. If the Fed can raise the rate 30 to 50 basis points, the various estimates, it'll clear FDIC fees. It'll be able to clear all the money market end of the curve above zero. At that point in time, competition is restored in terms of the sources. So my question for Gilles is, what happens to the European banks who lose the competitive advantage and their net interest margins on 1.3 trillion? And the question for Chris is, what happens to the American banks who get restored into a competitive environment and their interest margins?
To be honest, I don't know what to answer to this question. I don't know.
So let me just summarize then for today's session. First, of course, I got three different items above us to consider. One, when you leave this session, contrary to the rumor at the coffee break, this will not get you access alone to the gold vault. So please turn these in when you leave today. Second, of course, thanking Michael, Steve, David, and Don for all their great work in doing this. And of course, finally, thanking Jill and her team as well for all the great work. And we stand adjourned.